A stock is essentially a share in a company that gets bought or sold on an exchange. The two largest exchanges in the United States are the New York Stock Exchange and the NASDAQ. The historic average annual return for American stocks is roughly 7%. That's why adults invest. Now, as with most things in life, there are no guarantees. Some stocks perform better than others, some years are better than others, and some are worse. The trick is not to spend your life guessing which stock will do what. Less than 1% of us have the ability to stock pick. That number includes professional money managers. More to the point, if someone tells you they have a plan for picking stocks that will do better than the average return, don't believe it. The only game to play is the long game. Invest and then let your money work over a period of 10, 20, hopefully 40 years. You'll ride out the inevitable peaks and valleys and hopefully come out on top. Here are a few ways to start your long game now. The simplest way to start: invest in an index fund. An index fund is an investment designed to duplicate a common stock market category. That's called an index. How it works: instead of buying the 500 stocks that make up the S&P 500, which most of us can't afford to do anyway, you put your money in an S&P 500 index fund. If you have a workplace retirement plan, check off the S&P 500 option. If you are investing on your own, make sure to ask for one. Pro tip: avoid the obvious mistake. Don't buy any random index fund. There are indexes covering all sorts of things. You want to invest in a simple stock market fund that offers a good sampling of the overall stock market. That means either the S&P 500 or the Russell 3000, an index that's made up of the stocks representing the 3,000 largest publicly traded companies in the United States. That's 98% of the overall market. It's hard to get broader than that. Skip the target date fund. These are investment funds that are invested as though you will retire in a certain year, changing their mix of stocks, bonds, and other investments as time goes on. They sound like they will do it all for you, and they might, but they might not. Target date funds are run by individual managers, and all of them have a different secret sauce. It's no guarantee, no matter how much the name makes it sound like one. Don't get tempted by hot-sounding stocks. It may seem that everyone has a tip for the next stock market sure thing, their favorite store, or the next big tech advancement. Don't listen. Instead, find someone who will serve your best interests. If you seek advice, make sure to get it from someone who has a legal duty to act in your best interest. The word for that is a fiduciary. How will you know if someone is a fiduciary? Ask. Otherwise, you can get put in an investment designed to boost the seller's bottom line to the detriment of yours. Another pro tip: the nice man or woman at the local bank, so eager to congratulate you on graduating from college, not a fiduciary. Last, don't neglect an emergency fund. Stock market investments are for the long haul. They aren't emergency savings funds. If you lose a job or suddenly face a large unexpected expense, like your car breaks down or your laptop quits, and you need to cash out immediately, you could lose a significant sum of money letting go of your index fund if the overall market is lower than at the time you bought in. Make sure to have some money in a savings account at the bank to cover unexpected expenses before investing in the stock market.